Good evening, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hopefully, you guys had a very good day in the markets today. And in today's action, the S&P and the Qs a little bit lower. Now, the damage was mostly done by the financial sector after JP Morgan reported fairly good earnings, but went down 4% nevertheless. And additionally, you had Visa and MasterCard come down 4% apiece because of the infamous 10% newly proposed interest rate cap on those credit card networks, which would affect the banks a whole lot more than it would those independent networks. But most of the damage was done by not only financials, but also technology. Today, a few different sectors taking a very big bath. Look at the damage done in software, and we're going to explain why. And also, a lot of the damage came from some of your banking sectors overall. And the bottom half of the market, once again, guys, performing very well. Market breadth remains a very bullish point into the start of 2026. You'll notice here that consumer staples, they had a good day, up 1%. Consumer retail up 0.5%. Utilities up 0.6%. Real estate up 0.75%. And energy, very solid day for a lot of energy plays today, especially some of the oil companies, up 1.42%. So the market is still fairly broad. However, there are some pockets of weakness, and it does remain a market that is prone to some of those news headlines that come out on a daily basis. So in today's video, guys, we're going to take a look at a lot of different things together. Number one, we'll go over some news elements from today. Of course, we got CPI this morning. We'll review some of the CPI numbers and see where we stand. Additionally, we'll review some news headlines that came out today, one of which caused a bit of a disaster in software names. Take a look at the biggest gainers and losers of the day. Look at this: Figma down almost 8, UiPath down 7, Salesforce down 7. Some of the AI-oriented insurance corporations such as Root and Lemonade down, 6-7% apiece. Then you got Adobe down there, 5.4%. Many names associated with software, even Intuit, down almost 5% on a day like today. We know it's not been the easiest environment for software stocks over the course of the past year, and apparently into the new year, it's not getting any easier. So we'll cover a few of the news headlines, one of which heavily contributed to those declines. Thereafter, we will get into JP Morgan's earnings and derive why exactly did they drop 4% today, and is it possibly a good buying opportunity soon? Thereafter, we'll go through our regular technical analysis on our major market indexes, the SPY, the Q, and some of our minor sectors. Take a look at the rotation. Thereafter, we will do the same thing, take a look at our big tech name list, and derive into these companies' respective earnings, which are best positioned and which of them also are indeed in nice buying opportunities into those earnings. And at the very end of the video, yes, of course, we'll do everybody's favorite segment, the biggest gainers and losers of the day. Many software names and other names to the downside today. Could there be some buying opportunities there? We'll have a look. And also several names to the upside, a few key recurring themes into the early part of 2026. So without further ado, let's jump right into it, shall we? The SPY down 0.2, the Q's down 0.15. Already showed you the heat map, but just to reiterate, guys, big tech has largely been muted, right? It's been a while that we've seen all of the Mag 7 companies up at the same time. Today it was NVIDIA, Broadcom, Apple, Google, but we were missing a few, right? Tesla, Amazon, Meta, and Microsoft, even Oracle, fairly large player, down a little bit. Bottom half of the market, definitely the highlight of the day. Financials sadly coming down in a rapid fashion, and healthcare just a little bit muted. Take a look at the one-day relative. You'll see that even better. Energy and consumer defensives, aka consumer staples, your best performing sectors of the day. Somewhat of a mixed market to the downside. Technology, healthcare, cyclicals, and financials were your loss leaders. Now, on the 1 week relative, guys, we're still very well balanced here. Many more sectors in the green than the red for sure. Financials used to be green, but after a few days like yesterday and today, sadly, they're now red. But beyond that, the declines are not so steep. Technology and healthcare just slightly off their most recent highs. And on your 1 month relative performance, guys, you do remain fairly balanced. And that all has to do with the overall market breadth of the market, right? That being said, percentage of stocks above their 20-day EMA, very healthy, 62%. Percentage of stocks above their 50-day EMA, the closely watched institutional indicator, that's at 65%. We haven't hit those levels since earlier last year in July. And percentage of stocks above their 200-day EMA, still a very healthy 62%. So although the SPY retraced a little bit off its all-time highs, it's just very healthy market rotation. No real big negative catalyst in terms of macro, right? In terms of the fear and greed, we are still closely inching into the greed category. Not too much, which does mean that we still do have a nice runway of possible growth ahead of us. And that all dips, especially on our favorite high quality, high conviction companies, can still be buyable dips overall, right? Now, taking a look at the news segments from today, well, of course, we had CPI. CPI came in very early this morning, and we roughly came in at the expectation. Headline number was expected to be 2.7. We did come in at 2.7. That was pretty good. The improvements were on month over month, 0.2 versus the expectation of 0.3, and even on core right here, right? 2.6% versus the 2.7% expected. So slight improvements in CPI, still a little bit sticky in terms of the headline number there above 2.5%. But, you know, I like using the Truflation Index. It measures 15 plus million different products and services on a daily basis. And you can see we're at 1.74%. So inflation is definitely not a problem for the US economy, at least not in 2026. And we've heard as much, even the Fed with their preferred PCE inflation gauge. Well, they stepped down the inflation expectations for 2026 from a previously established 2.6% to the most recent 2.4% established during their December meeting. So even though inflation does remain a little bit sticky on the headline numbers, when you really look under the hood to a service such as Truflation, which is arguably a much better gauge of day-to-day inflation, because some people think that the overall headline numbers can be rigged. They leave out certain elements. They allow substitution. Well, here you have 15 million different products, and they are refreshed every single day as they are measured by SKUs, essentially, right? So 1.74, definitely not a problem. So the markets did take this release in stride. So where did some of the weakness come from, guys? Well, we'll cover that a little bit later. Well, actually, you know what I mean? Let's do it right now. The software weakness. Why were some software names getting absolutely crushed today? It was this news release right here. Introducing Cowork by Claude, a newer agentic AI feature, right? This is just AI agents that help you. As you can see the video running on the screen right now, it just helps you kind of manage your meetings, manage emails, manage team things that you might be doing at the office and other things of that nature, manage client expectations, follow-ups, all of that good stuff. It builds you a plan and everything like that, right? Cowork lets you complete non-technical tasks, much like how developers use Claude Code. Very interesting piece of software. I'll let you guys explore this one a little bit further on your own, but it's very nice, right? It works very well. But you know why? You know, they've been releasing, several LLMs have been releasing agentic models such as this, right? So these are a workplace efficiency products, of course, as you can see what it's doing right here, helping people manage their tasks all throughout the day. But the reason that it really tanked all of these names, because we know that this is nothing new, right? But you know what's new about it? This entire model was coded by Claude AI itself. There was no human intervention. Humans set the parameters, and then it took Claude, the AI itself, 2 weeks to build this program front to back. So obviously, when you have large enterprise resource planning companies, such as CRM, such as Adobe, which is another version, right? Obviously, they have different products and services, but you take a look at some of the other ones, right? Some of the software players like, let's say, Team or Monday.com or ServiceNow that spend billions and billions of dollars per year on research and development, very capital-intensive businesses to get up and off the ground, right? Well, when you compare that with AI's new ability to code these programs themselves for very low costs, well, it raises the concern and the question, right, of how sustainable are these large enterprise resource models? And will they possibly be replaced by different iterations of just agentic models that are coded by AI for free? So that's why software was down an absolute ton today. I mean, software has gotten pretty much pillaged by this AI narrative over the course of the past year. The concerns have always been the same. They've been pretty much the concerns that I described in the past minute, right? Are these companies still worth it in the modern day and age when you have free AI tools out there that could possibly replicate some of these businesses' models? Or in the future, maybe a lot of these products, issued by these companies, such as Salesforce's client relationship models or ServiceNow's enterprise planning software, which is literally very similar to what Claude just released, right? In terms of managing teams throughout the enterprise and managing different departments amongst each other. Well, if it's so easy for AI to code a program itself, do you really need a business that has thousands of employees and that spends billions of dollars per year on R&D for a licensed product? Or will companies be able to implement some of this stuff on their own progressively, right? That is a concern right here. And that's why a lot of these software companies were down an absolute ton over the course of the day. But we'll talk more about this towards the end of the video when we go through some of these names and we derive whether or not they're actually in buying opportunities or if we should just stay away. Now, other than that, we had a few big tech press releases today. Amazon pushing suppliers for price cuts ranging from low single digits to up to 30% ahead of an expected Supreme Court ruling this week on the legality of Trump's tariffs. So keep that in mind. Amazon had previously negotiated some cost structures with previous suppliers last year. And as a result, if the tariffs are somehow overturned, well, Amazon's pretty much going to look to get its money back, essentially. So this is one news headline that did move the markets over the course of the day today when it did come out. So pay attention to the tariff developments. Supreme Court ruling should be coming out possibly at some point in the next 2 days. Now, the Trump administration has said that there are many other ways to keep the tariffs active, but we'll just have to wait and see what happens with that Supreme Court ruling. On to another piece of news right here. Apple launching Apple Creator Studio on January 28th, bundling Final Cut Pro, Logic Pro, and Pixelmator Pro on Mac and iPad, plus Motion, Compressor, and Main Stage on Mac with new AI features and premium templates in Keynotes, Pages, and Numbers for $12.99 per month. Pretty decent offering there by Apple overall. And that definitely did not help Adobe in today's mess across the software landscape, of course, because some of these products from Apple do overlap with Adobe's products, and these do come at a slightly lower cost. Moving on a little bit further here, Microsoft saying it's launching a new effort to build what it calls community-first AI infrastructure, and says it plans to work with utilities and state public utility commissions so that electricity rates are set at a decent rate enough to cover power costs tied to its data centers. You might remember if you watched yesterday's video, President Trump came out yesterday after the close and said, well, they're going to be heavily looking into data centers and their demands on the utility grid so as to not increase utility bills for the average consumer while these companies are in their quest for data center dominance. We know that these data centers have a very heavy requirement. Now, obviously, there are two different types of utility providers, right? There are those that are focused on consumers and municipalities, and there are other ones called independent power producers that sometimes give electricity to the grid, but oftentimes have private contracts. The large tech companies have been going with the ladders in terms of providing utilities to the data centers, meaning they're going with independent power providers overall. So still something to keep a look at, guys. Energy will be front and center across everybody's minds this year for these data centers. And those were the major news headlines of the day, ranging from CPI to the impacts of this Claude cowork on some of the software companies and other key headlines from big tech overall. So not a super busy day in terms of news, but the pieces of news that were released definitely had an impact, right? That piece of news on Microsoft caused the stock to be down for most of the day, almost 2%. Then there was the Meta news yesterday, which carried through to today, being Meta trying to move into cloud computing, essentially. That was why Meta was down like 2% today. Amazon was down today because of that piece of news, but also because of the fact that they're raising some money for bonds over the next few years. Hundreds of billions of dollars will be issued in corporate bonds for Amazon. So there are some specific news headlines that did bring down some of the tech companies today, but today was largely focused on financials. And speaking about financials, let's jump into JP Morgan earnings. So JP Morgan down 4.2% today, closing at the low of the day. The bank actually opened slightly positive to start us off this morning, right? It wasn't a bad open. And then the algorithms kind of ran with it, just smashing the bid all throughout the day, unable to even break above the 12 EMA on the 5-minute. That's how you know it was a lot of algorithmic selling over the course of the day today. But they had very solid earnings. They missed on a few key metrics, and there were some comments by Jamie Dimon and the management team pertaining to the 10% credit card details, right? So in terms of their earnings, if you take a look here, TradingView compiles non-adjusted earnings, and that's important because we'll look at their earnings slides in a little bit here. So if you take a look at TradingView's non-adjusted numbers, it would tell you that they missed on EPS and missed on revenue. As a matter of fact, they did not. They actually had a very decent earnings release, but there were some little issues that you could pick apart with this report. And when you have a bank that's performed so well, take a look at these monthly timeframes, right? It's performed so well, and the financial sector, just the overall banks have performed so well that any little piece that they can pick apart and possibly drop us into consolidation, they probably will go for. So taking a look at some of the JP Morgan highlights right here, JP Morgan Chase tops the estimates as trading revenue exceeds expectations. Now, they didn't beat on everything, but they beat on the most important things. So if you take a look here, adjusted earnings actually beat the estimates, $5.23 per share on EPS versus $5 consensus, and the adjusted revenue figures, 46.77 versus 46.201. So they had very nice adjusted earnings beats. Now, the company said that profit fell 7% to $13.03 billion, or $4.63 per share. That, right, is the non-adjusted number that you're seeing right there. That would be the miss overall on non-adjusted numbers because of the pre-announced $2.2 billion reserve tied to its takeover of the Apple Card loan portfolio from Goldman Sachs. Now, we covered this news just a few days ago at this point in time, how JP Morgan was taking over the Apple Card business, and they're setting aside $2.2 billion in reserves for that. So that does take away some of your earnings power right there. That's one of the reasons that they missed on the non-adjusted numbers. Moving on a little bit further, company-wide revenue rose 7%, very healthy. Net interest income, the most closely watched metric for the bank, also climbed by 7%. Equities trading revenue surged 40%. And the banks have all been crushing it in terms of equities revenue over the course of the past 3-4 quarters as the markets have been very hot. And they're making a ton of money from that transaction volume through equities. Fixed income trading revenue also rose 7%, no problem there. Investment banking, however, appeared to disappoint as fees fell 5% to $2.3 billion, roughly $210 million below the estimates. So they beat most estimates here in terms of the other divisions. The only one that came in a little bit soft here was investment banking. But if you remember anything from the past 3 quarterly earnings from all the banks and the investment banks, these were very tough numbers to beat sequentially, guys. They had extremely strong investment banking numbers the past 3 quarters. So this one, a little bit of a slip up, but you know, when you're trading at a slight premium in terms of your share price, any little slip up, of course, will be magnified overall. We also had Jamie Dimon giving a few comments right here. While the labor markets have softened, conditions do not appear to be worsening. Meanwhile, consumers continue to spend and businesses generally remain healthy, said Jamie Dimon. These conditions could persist for some time, particularly with ongoing fiscal stimulus, the benefits of deregulation, and the Fed's recent monetary policy. Curious, that's exactly how we kind of set the table for the year, right? Ongoing fiscal stimulus, aka big beautiful bill, tax benefits, right? The benefits of deregulation, also something big, and the recent monetary policy, meaning, well, the lowering of the interest rates over 2026 and also the end of quantitative tightening. However, as usual, we remain vigilant and markets seem to underappreciate the potential hazards, including from complex geopolitical conditions, shout out to Venezuela, the risk of sticky inflation, and elevated asset prices overall. So still Jamie Dimon giving his good old good news and then followed by some bad news. He always has to do that, right? In terms of just trying to get you as a client for the bank, right? In times of great uncertainty, you should bring all your assets to JP Morgan because we know what we're doing. Classic speech by the bank CEOs, but at least he did say that we did have some nice macro tailwinds in the mix, right? So the bank earnings were not perfect, but they were just good enough. You'll see they beat on a lot of things, but total deposits coming in slightly under the expectation. That's another little point to add to the bears right there. Investment banking revenue, we already talked about it. That was a miss for them. Return on equity, that was also a slight miss, 15 versus 15.7. It's a very closely watched metric for any bank out there. And then overall, you did have a slight decline in your capitalization ratio, otherwise known as the CET1 ratio, 14.5 versus 14.8. However, when you do go through the banking slides, which I do, they do justify that by saying, where is it? They do justify that by saying, well, that it's because of the impact of the Apple Card overall, okay? So that will be reduced over time potentially, but slightly lower. We also know that the Fed did reduce a few of the liquidity requirements for the banks overall in the past few quarters, which allows them to take on a bit more loans as financial conditions ease for them. But overall, if you take a look at some of their slides, the most important slide for me, especially in times where the consumer is front and center in the lens, net reserve bill. This is how much money the banks are setting aside for potential defaults on their different credit offerings, right? But the one that people pay most close attention to is in relation to consumers. The net reserve bill here is $2.2 billion. That was driven by a $2.2 billion reserve established for the purchase commitments of the Apple credit card portfolio, excluding the forward purchase commitment for the Apple Card. Reserves were flat, as the effects of updates to certain macroeconomic variables were primarily offset by loan growth in card services. Essentially, what they're saying is, yeah, we didn't really put any more money to the side because we don't really believe the consumer is that much at risk. Okay, and you can even see that down here. Card services net charge-off rate, did it get better or worse this quarter? Well, it's kind of exactly the same as the third quarter of 2025 and a little bit better than the 2 quarters ago, which was fourth quarter of 2024, or rather 1 year ago, excuse me, fourth quarter of 2024. So card services net charge-off rates still fine, and the bank not putting away that much money. So there were a few little key highlights that can be a reason for the decline today, but one of them that for some reason is not in the CNBC article is on the earnings call. Obviously, Jamie Dimon and management were asked about the new 10% credit card caps, essentially. And they said, well, if they were to go in place, because it's a big if, right? This has to pass through Congress, obviously, and the probabilities of that going through are not very high, right? Well, obviously, the bank had something to say about this. And essentially what they said, I'll paraphrase here, but Jamie Dimon and management team basically said it would not be good for the economy nor for the consumer, because it would kind of limit access to credit for a lot of lower income consumers or more at-risk consumers in terms of the ones with lower credit scores and things of that nature, right? Now, these are all second order effects, right? One could argue that there are some pros to a 10% credit card cap, right? Such as the consumers that have good credit and very good incomes that can afford to have these credit cards. Well, they will probably be purchasing more. So more volumes will be running through those networks. Obviously, the banks stand to make less in terms of interest margins on those credit cards. But the second order effects to the downside are the fact that, well, people in the lower income demographic or people without very solid credit scores, well, they might just be blocked from obtaining new credit cards or maybe blocked from existing credit cards because the bank doesn't want to take a risk at only a 10% interest rate to lend money to those folks on a revolving monthly basis. So obviously, right, these second order effects will have to determine which ones will be more important, but all of this so far is speculation because we don't even know if that 10% credit card cap is going to pass. But that was also something that did contribute, I assume, to a bit more of the velocity to the downside. Sure, the bank did miss on a few key metrics right here. But overall, you know, for face value, guys, it was a very solid earnings report from the bank. They referenced the solid macro tailwinds. They said the consumer was still fine, and they did have very good numbers of their own. That being said, you guys know earnings is always a casino. And even though the bank had pretty good earnings, sorry, I got something in my eye. Well, unfortunately, their stock price suffered the consequences, but it doesn't remove anything from them, nor does it issue any big red flags for 2026. So that being said, is JP Morgan a buy after their 4% decline? Well, JP Morgan is not a stock that I own, but arguably if I had to buy any one bank in the US markets, it probably would be the biggest and the best in my opinion. Largest bank on planet Earth at this point, and just keep in mind your key levels down here, possibly 300 to 290. Back tests, right, of the 12 EMA on the monthly time frame here, but also some of your previously established support locations, right? So this dip on JP Morgan could be an interesting buying opportunity. We are now cooling off the monthly time frame in terms of the RSI. That was very much needed. You're cooling off the weekly RSI, and the daily is slowly moving towards oversold conditions. If you can couple daily oversold conditions with some nice support areas and your 200-day EMA right there, which is also consequently the monthly 12, it could be a very interesting buying opportunity. JP Morgan is not something that I trade that often. It is something that is not too bad for a buy and hold forever type of stock, right? Pays a very solid dividend, all things considered, highly profitable bank, and a very consistent bank, right? You don't really have to worry about JP Morgan moving forward. Very consistent growth in EPS and a very consistent growth in revenue, although they're not the fastest growing company, right? At least they are always there. We're not getting the best discounts. The best discounts are arguably during tariffs. But if I had JP Morgan, would I mind adding a bit of shares right here into a monthly support range? No, not at all. Very high quality company. And that wraps up your earnings for today. Tomorrow, of course, we will cover a couple more in the names of Citigroup and possibly Bank of America with Wells Fargo And thereafter, on Thursday, you got TSMC, Morgan Stanley, Goldman Sachs, and BlackRock for us to explore a little bit more. So now that all that's out of the way, the news and the bank earnings, let us jump into some charts. So for the index breakdown, guys, the S&P, no red flags whatsoever. It's just a very clear daily uptrend right now with the bulls in absolute full control, right? Very nice push off the bottom right there. Nice daily uptrend underway. So any move lower, we got a lot of room here under the line, above the line in the sand level, which is 680. And you got decent support down here as well, 683 down to about 679. No problems whatsoever. Just keep the rotation in mind, guys. There's a bit of everything. There's a bit of everything for people in the markets this year, right? We know that dividend stocks have been having a great start to the year. Consumer staples, which have been nowhere to be seen in the past few years, they've had a great start to the year as well. The weekly uptrends overall. Consumer retail is doing a lot better as well too, right? Utilities have been fairly good into the early portion of the year. Real estate also is coming back, and even energy. So there is something for everybody in this market. So even though I know big tech hasn't really done much of anything, I mean, maybe other than Google pushing new all-time highs, right? But the rest of big tech hasn't really done anything. And even some of the fan favorite plays from last year haven't really done much, right? The SOFIs of the world, the Palantirs of the world, the Robinhoods of last year as well. A lot of the fan favorite names from last year are just nowhere to be seen into the first 2 weeks of January. But if you broaden your horizons and focus on the themes that we established last week, well, you're probably finding that a lot of key names are doing really well into this year. So focus on the breadth of the market, right? I see no red flags here in terms of macro, and I also don't see any red flags in terms of price action. What you're seeing right now is just very natural rotation. Moving on to the QQQs right now, QQQs struggling. I mean, look at the SPY. Where the SPY is and look at the QQQs. If that doesn't show you how weak big tech has been, I don't know what will, right? But still, healthy little uptrend underway right now. I mean, this little candle structure right here is a bit awkward, but take a look at the, if you take a look at the futures market, right, it does paint a bit more of a clear picture in terms of expansion, tightening wedge, you're trying to break out through the top right there. I don't believe that these big tech names will do much. I mean, we can derive that same location right here, yeah? I don't believe that big tech names will do much of anything before their earnings, but we do have a decent amount of space right here. Anything above the line in the sand level 610, just looking for a higher low on any weakness for possible further trend continuation. Support levels below 613 on a 605. The VIX is also quite low. Tightening wedge on the weekly time frame as well, looking for the little bit of a breakout. So no red flags, but we know that big tech really hasn't got that money rotation. A lot of them have been somewhat flat and just awkwardly doing a whole bunch of nothing. So that's why your QQQs are underperforming. I wouldn't count big tech out just yet. It's just that the money's been rotating into other sectors of the market to start off this year. Moving into financials, we talked about it today, right? Several segments of financials were down in a pretty big way today. The credit card companies and the banks, especially because of the JP Morgan decline right there. And this is a situation that we kind of thought about yesterday, right? What happens if you lose a daily uptrend? Well, now we've lost it. They undercut the lows, 54.35. So your daily uptrend has now been lost. When that's the case, any bounce looking for a lower high, maybe into lower low. Support coming in right now, 54 down to about 53.5. Overall though, guys, what are we looking for here? It's just healthy weekly consolidation, right? Just looking for a weekly higher low in a support. They can even drop down a little bit more, and that wouldn't be so awkward. And on the monthly time frame as well, right? It's just a nice monthly uptrend of expansion. So a little bit of consolidation here doesn't hurt anybody. As I said, you can pay attention to JP Morgan, probably my favorite company out there if I'm bidding for a bank, or even Visa and MasterCard. I believe these sell-offs on Visa and MasterCard are largely overdone. People forget, right, what type of company Visa and MasterCard actually are. They are just payment networks. They just collect small fees. They have nothing to do with interest overall, but it's a psychological battle right now for people, right? If the 10% caps go into effect, well, which effects are going to be more powerful? The banks not being able to loan credit to the lower income demographic and low credit score demographic, will that offset volumes enough? Versus the people that will still have access to credit cards that will be able to use them arguably more because the interest rates will be lower. So those two forces will kind of counterbalance and offset themselves in terms of payment volumes, which is the most important thing to look at for Visa and MasterCard. But also, people forget that this is a worldwide duopoly, right? We're talking about all of Asia, all of Europe, Latin America, Australia, and even up here in Canada, right? So these are worldwide companies. I do believe that this sell-off is a bit overdone, but hey, I mean, we're back into the buy locations for Visa and MasterCard. Phenomenal location to be picking up some shares if you want to hold these for the long-term portfolios. Once again, trading at some of their lowest valuations that we've seen, guys, on Visa and MasterCard over the past few years. It's now been like a year of doing nothing on these companies, all while they've just been slowly but surely improving their earnings. So they go into these consolidation phases every now and then. Doesn't happen too often, where they just do nothing for a whole bunch of months while improving their business fundamentals. So I do think that the credit card companies could be very interesting pickups if you can look beyond this news catalyst from today. Moving on to healthcare right now, XLV down about 0.41% today. I mean, it's still a very healthy daily uptrend, right, in the grand scheme of things, looking for the higher low for possible expansion. If you unwind a la financials, right, if you unwind this right here and you go for the daily up and you go for the daily downtrend, just remember what's at stake. You might just be looking for a bit of a tightening range, similar to what the QQQs are doing right now, right? Maybe it's just a tightening range up here. And even if you unwind this overall, healthcare is still going to look very healthy, no pun intended, sorry, into 2026, because you got the monthly breakout, right? Beautiful breakout, just looking for a back test. Worst comes to worst down here, 150 down about 145. Let's call it this little pocket, the breakout, the retest, and possibly the run. This would be a nice key area to watch over the course of the next coming few weeks if you get that, because I would be playing this one myself as well. On to semiconductors today. Semiconductors up 0.22%, but it was somewhat of a mixed market in semiconductors, as you can tell, right? Not everything was higher. Some of the equipment manufacturers a little bit mixed here. LRCX down 3, and then across the semiconductor landscape, you had some ups, you had some downs, but look, AMD and Intel having a very good day today, but just the bigger players, Broadcom and NVIDIA, still not doing too much, right? So semiconductors looking fairly good here into the rest of the week. Daily uptrend. We know that TSMC has earnings on Thursday. That's going to be your semiconductor volatility event for the week, but we're looking quite good. You can see from this awkwardly drawn line right here that indeed is your previous high. So even if we lose this temporary daily uptrend and unwind, just like financials just did, and you go into the downtrend, what are you looking for? When in doubt, always zoom out. Just looking for a bit of a weekly higher low, right? Anything above 338, weekly higher low for possible further trend continuation. So no red flags across most of your major indexes, right? We covered the larger aspects of rotation yesterday. I'll only go through these other minor indexes on Mondays and Fridays, just so that we can keep the videos midway throughout the week a little bit shorter. So moving on here, we had a bit of an expansion here on the VIX, but nothing really notable, right? It's been doing that the past 2 days because of all the news releases by the Trump administration. But overall, are there any macro conditions that could lead us to a massive expansion in volatility? No, probably not, right? And even on a day like today, where you have a big bank going down, the volatility doesn't expand that much. But when you do get some volatility expansion, you can find some attractive opportunities on the lows. Decent opportunity to be selling some puts on your favorite companies. One of the ones that I picked up this morning was Affirm, right? Affirm has nothing to do with the credit card sell-off overall. If anything, maybe it pushes people more towards buy now, pay later if they can't get a credit card, for sure, right? So they were down like 5% early morning, and we were always playing this pocket, right? So I was able to get a 68 short put off for some decent premium into next week. But even some of the credit card companies, right, like Visa, MasterCard, they were offering fantastic premiums for selling some put options for, 2 weeks of time, 4 weeks of time in these lower locations at fantastic valuation. So sometimes when the VIX has a little bit of a pop off and individual stocks also get a bit more volatility, well, you can get some really attractive levels if you know where to look, if you're shopping for some short put options or looking to farm some credit in the overall markets. Now, that being said, let's move into some metals right now. So metals, not a bad day on the Tuesday session, right? This is the overnight session that we're into right now. You can see gold is up 0.66. Still the highs right here. Very casual daily uptrend for gold overall. Any weakness, just looking for a higher low, anything above 44.14, looking for a higher low. Could be an interesting backtest location for some swing trade longs if they offer it, right? You get a backtest into here, into this location with the daily 12. They've been riding the daily 12 for so long at this point, right? So then the stop loss would go below 44.14, and then you'd be targeting psychological expansion levels such as 47, 48 thereafter. So gold not looking too bad. Daily still in full bull control. The weekly is still in bull control as well. Beautiful weekly uptrend right here. Overbought conditions still, but we know that. And monthly overbought conditions are quite significant right now. Although I am bullish on gold for this year, it might not just do it in one straight line. Eventually we might get a pullback to cool down the RSI. At least that's the hope. And that is something that you could be looking for a bit larger positioning. As right now, there's really only some small swing trades that can be made level to level trading, as we are fairly extended on the timeframes. And silver is kind of the same concept. Beautiful expansion move by silver over the course of the Tuesday session, up 2% and up another 2.4% during the overnight session right now. So solid move. They established the base. We were talking about that on this retest right here, right? Previous little resistance highs. They came into support, right? It's over the base. So the entry was there. Stop loss was there. Expansion was towards the highs and psychological targets such as 85 and 90. You are now there. So congratulations if you did participate in this silver swing trade. Silver is just gone at this point. We've talked about it many times as to why, right? Several components. Silver is being used in several components, anywhere from, automobiles to industrial machinery, different electronics applications overall, and things of that nature, right? This one, a little bit of gold, and especially copper, which is going to be something big to pay attention to in the next few years, in my opinion, just because of all the data centers and semiconductors and things of that nature, right? But silver looking great for the expansion, but still level to level trading, right? Positioning up here, very greedy long because there's no stop loss location, especially if you're going for a larger swing trade, right? $100 psychological target is definitely the next area to pay attention to. Weekly, very overbought conditions, and the monthly, extreme overbought conditions as well. But the bulls remain in full control of this chart right now. So congratulations to everybody who's been playing silver or maybe even holding silver since the low 30s. You guys are probably loving it. Is it a good opportunity to be clipping into some profits? I do think so. Not saying selling the full bag, but maybe establishing some trailing stops below as you keep inching higher. That's what we were saying to do yesterday. So as we keep establishing these higher lows, we can establish new trailing stops to kind of clip out of a few of these positions, right? Moving on to some of the crypto names today. Bitcoin, super solid day today, 4.6% to the upside. No news, but we know that it's just been coiling here, right? And we also knew, as we said on the channel, that this one would largely be beholden to the direction of the overall markets. And we know that the overall markets have had a bullish leaning bias recently. And we also know that the market rotation has been broadening out. Several risk-on assets have been performing quite well recently, and the new one is now crypto with a bit of an expansion leg right here. So nice further leg of daily expansion on the daily time frame. New higher lows are set at about 89,000 right now, and finally maybe you can actually close a weekly candle above 94,000. You do that, you finally get the weekly time frame back. Your weekly MACD is looking pretty good for some possible expansion. Next stop right now, 100,000 up to 107 is your previous resistance range. And you got to do it one time frame at a time, right? They got the daily uptrend. Now you got to give me a weekly uptrend shift as well. And then eventually you're going to have to kind of get some juice here on the monthly. I don't know if they have it in the cards here to go for the all-time highs in one swing. We never lost the monthlies, right? But we were always saying down here in terms of the ability to swing trade this one, well, the swing trades were kind of live into consolidation here with the stop loss below there. If you're long, well, you guys know where your take profit is. 100 through 105, not looking too bad. And even on something like Ethereum, right? Ethereum is expanding quite well. Same entries on Ethereum for some swing trade longs. We're in this little pocket down here, stop loss below there, looking for the higher low. For the expansion trade, it's now here, take profit 37 up to 4,000. So decent lift, or you can just play the breakout from here. I mean, the risk reward is not fantastic, but if you're playing this from here, stop loss is below 3,000 at this point, and the trade would look something like this, yeah? You're going for the weekly trend expansion on the breakout. So it's not the best in terms of risk to reward, right? It's like a 1.5 to the midpoint of the resistance range, 38.50 right there, but it is something, you know what I mean? So Ethereum not looking too bad. Daily uptrend expansion, weekly also going for the weekly uptrend recapture. That would be a close above 34. Okay, so keep that in mind. If you get the weekly back, first time in a long time, weekly MACD looking good for the curl. And lastly, the monthly was always looking for a bit of a monthly higher low, right? Monthly expansion, higher low, looking for the re-expansion. They'll have to get through this resistance area first, but we were saying with the swing opportunities that I just described, right? These are just long-term accumulation ranges. If you believe in the expansion thesis of Bitcoin and Ethereum in the long term, it was a nice area to just be nibbling progressively at these lows for possible expansion. And now we might be getting it. Who knows? But it's looking a little bit better than at least it has over the course of the past month. So we'll keep a close eye on the expansion of those trades as well. Now, moving into some of our big tech names. So first off, moving to Apple, we're going to cover these a bit quickly because not much has changed. And I say that often, but it's true, right? A lot of these companies have earnings come up in the next 2 weeks. And I don't believe that we're going to have massive breakdowns or breaks to the upside much before their earnings. But let's derive some short-term areas of price control. Apple, daily downtrend, clear as day. They're going for the upswing out of daily oversold conditions. Doesn't happen that often on Apple, right? Daily oversold conditions. I mean, the last time was during the big tariff sell-off, but prior to that, whenever we clip into daily oversold conditions like that on Apple, it does tend to mark some form of a local technical bottom. So now we got the bounce, next area of resistance, 266, 270. Anybody who is in short puts, that is where we're kind of gunning for some expansion to be able to close those trades. And then who knows? Maybe we just get sent down a little bit further on Apple leading into their earnings. I think Apple's going to have a very nice Q4 overall with their iPhone 17 sales metrics. And right now, we're just looking for some consolidation, right, on Apple. It had a phenomenal monthly rally, and I'm just looking to do the good old breakout retest, right? Breakout of the previous highs, retest possibly down here. The sweet spot is 256 down about 245. So this little sweet zone right here could be an area to scout out some trades, but maybe we will have to wait until earnings to get the best possible positioning on those to be able to determine if they're able to recapture this for the breakout retest for some swing trade longs, or if we just break down further here, further into daily oversold conditions after earnings and get the best possible entries into the 240s for some longer duration swing trade longs, meaning like for the rest of 2026, those would be the best possible entries. But as of right now, I'm not doing much of anything on Apple other than selling some short puts down here. The valuation at 250 is still somewhat a little bit extended. Moving on to AMD right now, AMD getting a very big price target upgrade today from KeyBank up to 270 because of strong CPU demand and strong data center demand as well. That being said, no change in price action structure for AMD. We've still just been trapped, right? In this little range here, call it 220 down about 200. Every time it comes down to 200, you guys know the drill. I'm always selling some short puts down there, as even though the daily price action doesn't show too much activity whatsoever, well, the time frame that's a bit more clear, guys, is the monthly, right? Daily is very choppy, or has been very choppy at least. The weekly also is very choppy. The clearest time frame has always been the monthly. We've been commenting on this for several months in a row at this point, looking for a monthly high or low, kind of like Apple, right? And the worst could have possibly sent us down 190, 175. We weren't too sure if we're going to get that. But you see, we're kind of reacting from these previous highs right there. Not looking too bad for some re-expansion. I think AMD, guys, and I've been saying this for like months and months and months, and even prior from back here, right? AMD is probably going to have some phenomenal years ahead of it this year and 2027 because the fundamental thesis was never at question, right? Around 200 or 220, trading at a under one peg or close to a one peg right now with the 10% expansion above 200 overall. And the long-term thesis is still very much intact, right? So no sense in looking at this one on a daily basis. It'll fluctuate with some volatility, but the EPS expansion is what you should be focused on. EPS expansion, revenue expansion for the next few years, and additionally, the margin expansion. So this company is just prepping, in my opinion, for a next very large leg higher throughout 2026. Moving on to Amazon right now. Amazon down 1.57%. This was always going to come. We were talking about this the last few days, right? Beautiful 10% leg right there. And now you're just getting a bit of a retest down here, maybe of support, 240 down to roughly 230, let's call it. You can see that even better on the weekly timeframes, right? Nice weekly expansion, close at the highs of last week. Maybe a back test is in order. The monthly timeframes show something even clearer, right? Looking for the expansion leg for Amazon overall throughout 2026. And their valuation around 235 is very fair. So Amazon, a few key things here. Yes, we can add a bit more shares, but if we backtest this area a bit more, well, we could possibly find some short put opportunities down there in 230. So I love Amazon into 2026. I think they'll have a very good year. The reason that they were down today specifically, well, was because they said that they were going to issue some bonds this year into next year for their data center build out overall. So a bit of a debt raise by the company. That never goes down well with the markets in the short term, but the thesis for Amazon's expansion is very clear for the medium to long term, in my opinion. Still one of my favorite plays in 2026. Moving on to Google right now. Google, super solid day. Again, brand new all-time highs, 1% to the upside, daily bulls in full control. A lot of room here. Anything above 310, looking for a new higher low for possible further trend continuation. And it's just full bull control here on Google. And that is across all your time frames. The daily is back in overbought conditions. The weekly as well is still in overbought conditions. They've been here for quite some time at this point. And even if you wind this down, right? Daily downtrend, you unwind this into earnings. Well, got a lot of room here above the weekly higher lows, 300 weekly higher lows. So tons of space here to reset the time frames, but everything is very overbought on Google, guys, which is why I've been saying Google is probably one of my favorite companies in the market right now. And I'm not selling any of my long-term shares I'm just not buying anymore up here because the valuation doesn't really make sense that much anymore. It is trading at the higher end of its valuation range. It's very extended on multiple timeframes, the monthly and the weekly. So adding Google up here is tough. It's a very greedy trade. Now, sometimes greedy trades can work, but you know you're not getting the best risk to reward, right? So Google, very solid companies. There's just nothing for me to do here at the highs in terms of any swing trades or maybe selling some put options either. But that's just how I trade. Moving on to Meta right now. Meta down 1.69%. The market not liking Meta's push into cloud infrastructure because it might require a little bit more CapEx. I mean, it's to be expected, right? But at least they're pivoting away from reality labs, right? That being said, daily downtrend and almost cracking and closing through the support range, 640 down to 630. It's not the biggest area, but it is the closest one that we have, right? A little bit of price action there, a little bit of price action there, a little bit of resistance here, and also here as well. So not the largest location, but still an interesting one to pay attention to. If you slide a bit further on Meta, then you get down to the juicy location, which is the good old 600 down to 560 location. This is like best price on Meta. I mean, it's already a good price if we're looking for some shares. At 630, you're trading at a very low 21 forward PE, a 1.63 PEG, a decent free cash flow yield, although not the highest, right? So a lot of focus will be on Meta's earnings. They should have very strong earnings in terms of their legacy business, but as per usual, it's going to be a large focus on the CapEx, the expense profile of the business as well, and how that is impacting their margins and free cash flow, right? That is why the stock dropped right there. And still in weekly consolidation now, and still in monthly consolidation too. So a little bit of a revisit down there could be a nice opportunity to sell some put options into this very large support area, the 12 EMA too. So this is how I'm playing Meta, right? Meta is for me just adding shares to the long-term portfolio. And if I have a big account, which I do, and some of you guys also have, right? Selling puts down there, lower 600s, I think there's some great risk to reward. Moving on to Microsoft right now. Microsoft down 1.36%, cracking some of these lows. They haven't lost all the lows, but you can clearly tell, right? The bears are just in short-term control. Rejection from resistance, 500 down to 490. So more price action declines. Microsoft with their earnings the 28th of January, so not that much more time. If you choose to drop one more level, because the bears control the short-term timeframes, that's been very clear, right? Inability to reclaim support. If they drop you one more level, you're going right back down here to the highs of 2024 and early 2025, which is specifically 450 down about 430. This is like best zone to be picking up some Microsoft. It is very healthy monthly consolidation. We've been battling with the 12 EMA right there, which is consequently as well the 200 EMA. If we drop one more level, guys, when is the last time that we've been able to pick up Microsoft at the 26? During the tariff sell-off, during the bear market of 2022, and before that, when? Not much, right? 2018 tariff sell-off and barely COVID. So you know that if you're buying Microsoft between the 12 and 26, usually a good buying opportunity. You find nice technical confluence, a nice technical sell-off, a nice support range below us, and a very fair valuation, in my opinion, under a 34 price to earnings and a 1.66 peg. So this is the area, right? I didn't touch Microsoft up here, but here I am playing a few things. Leaps with long duration, deep 2027, and also selling puts in this lower location into support. Very decent proposition, and also just nibbling on some shares for the long-term portfolio. All good propositions in my opinion. Moving on to good old Netflix. Netflix was up 1% today and a little bit more in the after hours. An additional, well, I guess you can't see it right now, but a little bit more in the extended hours right there, another 1%. And that is because Netflix was doing their offer to be potentially an all cash offer, which is better than cash and equity, of course, for shareholders of Netflix, that being said. So still though, daily downtrend, who's in control, right? We have not recaptured this 12 EMA for like 3 months at this point, right? At least 2 months. So that being said, the bears remain in short-term control. Step number one, as always, right? Give me a nice daily bounce, recapture at least the 12 EMA, give me a nice bounce, and then reset the trend. We don't have that much time though, because they have earnings next Tuesday. So I do believe that Netflix will largely be, the price action is going to be beholden to earnings, right? Either we're finally going to get a nice engulfing move and the ability to reset some timeframes, come out of oversold conditions on the daily, oversold conditions on the weekly, and finally get a daily leg going and maybe even a weekly leg, because it's just been weekly downtrends so far, right? Because of the Paramount deal. Or the Warner Brothers deal that they're battling with Paramount, right? So one of two things is going to happen after earnings. It's like a 5 to 7% expected move. Either we come to the final resting place, mid 80s for Netflix, or you finally get some sort of a bounce underway to reset some price action structure. Regardless, if we're looking to buy Netflix here, I still think it's a good proposition around 90 or slightly under. Fair valuation, in my opinion, under a 30 forward price to earnings, a 1.4 peg. And we can't forget, at the end of the day, Netflix is Netflix, right? Strong free cash flows, strong net margins, great revenue growth, and overall just a very consistent business, right? Very consistent EPS growth, especially for the next 4 years, and very consistent revenue growth as well. So there's been some sentiment damage to the stock because of the ongoing deal, but not only to them, right? Even Paramount stock has just tumbled and tumbled and tumbled, right? So everybody's losing in the Warner Brothers deal, except for Warner Brothers, right? They've rallied a significant amount because of that deal. But there you go, right? So I am buying a little bit of Netflix down here as well in terms of for the long-term portfolio. It may take a little bit of time to turn around, but I think the turnaround is all but guaranteed. Moving on to NVIDIA right now. NVIDIA up 0.47, but NVIDIA still doing nothing, right? 185 down to about 178. This big resistance and support range, resistance, support, support, resistance, support again. The bulls are trying to play some defense right here, trying to go for the uptrend expansion on the daily, trying to go for the uptrend expansion on the weekly timeframes as well. And overall, just very healthy sideways monthly consolidation, right? Not quite at the 12, but we did come down very close to it in the most recent few months. I still really like NVIDIA at these locations. I was very pleased with what they said during their, during their conference back here in the late stages of October. I was also very pleased with their CES conference as well. They're doing very good things. They have very strong growth numbers overall. Their past quarterly earnings were excessively strong. We don't get to hear from them until the end of February, but still a very decent location because it's such a nice area of accumulation. There's a few things we can do. Whenever we have red days, we can sell some put options down here. We can also accumulate some shares, or if you guys are willing, even some leap call options, not the worst because the valuation does support some expansion here at around 175, 180. You're trading low 20s forward multiple and around a 1 peg. So NVIDIA, fair value, in my opinion, should stand closer to like 230, 250. So at this point in time, we're still somewhat undervalued and just kind of coiling up maybe for the next big leg of expansion for NVIDIA, but it hasn't been doing much recently. But not because the company's not doing well, of course. On to Tesla right now. Tesla making its way into resistance, 460 and on a 450. We had the big sell-off here after deliveries. But what are we doing, guys? We're just normalizing some of the higher time frames, right? You see it best on the weekly and monthlies overall. So weekly downtrend, engulfing move. Now they're looking to reset the weekly timeframes, right? Nice back test into the support range right down there, holding the 12 weekly EMAs and just looking for some expansion. But we know that big tech, right? There's been some ups, there's been some downs, but largely big tech hasn't trended for a while, right? I mean, you take a look at Tesla, right? There's been some ups, there's been some downs, but we're the same that we've been for the whole last quarter. Apple is like the same thing, arguably, right? Since October. AMD also the same thing. Since October, we haven't done anything. Amazon since October, since their last earnings, we came down after the tech sell-off. We haven't done anything. Google has been the exception to the rule, right? They're the only one. Meta hasn't done anything. Microsoft hasn't done anything. Netflix definitely hasn't done anything other than go down. NVIDIA hasn't done anything in 6 months. There's been some ups, there's been some downs, but nothing. And it's like, it's not a trend. It's not very clear trending action, and Tesla largely the same, right? So I think that the Mag 7 will all kind of come back in unison. That being said, Tesla does have earnings in the next 2 weeks. So we'll pay attention to that one. But the chart, not looking too bad overall, just sideways monthly consolidation. They're kind of coiling up here. You wouldn't be surprised if they go for the breakout with the rest of the Mag 7 that's been doing nothing. On to Palantir. Palantir is another trade that for a better part of the last, 3, 4, 5 months, there's been some ups, there's been some downs, but this one has done absolutely nothing. Absolutely nothing. Phenomenal company, phenomenal earnings, but hasn't been doing nothing. It's not trending to the same degree that it was out of 2024 into all of 2025. It's just been doing a whole bunch of nothing. So the timeframes are a little bit mixed right now. We're still in the confines of support, 185 down to 171. Line in the sand is down here. Can't lose that, or big daily downtrend and further weekly consolidation as well. Maybe, just maybe, we're just going to tighten up. We're just going to stay kind of range bound up here. Crazier things have happened. But as I said, the popular plays of 2024 and 2025 haven't been doing anything for the last 3 months. Palantir, SOFI, Robinhood, a lot of the fan favorite names from last year are just nowhere to be seen over the course of the past 3 months. But that's very normal. The money shifts, the money rotates, right? So Palantir is still a very solid business, but I would be more keen on paying attention. If we do get the breakdown there, you might see me selling some put options down here, 150, but Currently, no trades for me overall. If you wanted to try your hand out of a swing trade, stop loss is there. And obviously expansion target would be 210, as you just be looking to tighten this up into the support range and then possibly go for the big breakout long. Moving on to SOFI right now. SOFI also, I mean, what has SOFI done over the course of the past 3-4 months? Absolutely nothing. But if you enjoy some of these names, they can be construed as some very nice accumulation ranges, right? There's been some ups, there's been some downs, but largely we are at the same place that we were last September. So the valuation on SOFI is good and the technicals are good as well. Whenever we get some weakness on SOFI, it's a nice opportunity to sell some put options down here, 25 to 22. I've been saying that for the past 3 months. We've made us so much money selling put options down here. It's almost been free money, resistance, support, and just looking for monthly consolidation on SOFI. That being said, around 27, it's a 1.1 peg, which is fair, and a 7.34 price to sales. Not too bad at all for SOFI. So until we actually get some trends, until we break through 28 to 30, give me the trend expansion, right? I'll just still sell some puts down here and or just accumulate some shares if we wanted to build a position with the premise that SOFI eventually will be a $50, $60 billion company. It's just pending its next big leg of monthly expansion. After doing a 3-4x in like 6 months, well, now it's just a normal phase in which we see consolidation. Same thing for the rest of big tech and some of the retail fan favorite names of last year. Moving on to Uber right now. Uber, a nice 1% uptick today. Still daily uptrend control by the bulls, looking to establish a daily higher low to possibly attack this resistance range again. Line in the sand, 79.53, and to the upside, 87 up to about 91, the infamous Great Wall of Resistance. It's been a weekly downtrend, so the bears are indeed still in control of the medium and even longer time frames, just looking for some monthly higher lows right here. So the way that I'm playing Uber, any weakness, I'm selling put options down here, but even accumulating some shares if Uber is your style of company and you want to go for the continuation longs here, 2026 and beyond, because the company is putting out very solid fundamentals, very strong free cash flows, $20 billion in buybacks as well. And you know the valuation down here at 80 is quite manageable, right? Low 20s forward multiple and a 1.43 peg. Arguably, the valuation trades a little bit cheaper than some other tech companies because there's the constant overhang of autonomous vehicles, right? Even though Uber is partnered with so many autonomous vehicle networks worldwide, still, it just doesn't get the multiple expansion because people are still worried about autonomous vehicles competing with Uber's business down the line, right? Talking like 4 or 5 years plus. And now lastly, moving into TSM. So it's tough to derive the short-term price action on TSM because they have earnings on Thursday, right? The expected move is going to be like 5 to 7% on this one. So 5 to 7% from the upside from here puts you beyond 350 at new all-time highs and just daily uptrend continuation. 5% to the downside puts you right back into support. And don't be surprised. I mean, they had great earnings last time and they still went down, right? So maybe TSM has just rallied too much into their earnings. And even if they release very solid earnings, maybe we just come down. If that's the case, you might get some really nice re-entry trades though. Weekly uptrend, kind of like SMH. Backtest, look for it, watch out for it. 310 down to about 300. It could be a nice backtest for some further swing trade longs if they do offer that. But no swing trades for me into earnings. I'd rather just wait and see. If they come down a little bit, we can maybe re-explore, but we will cover their earnings together on the channel come Thursday evening. Valuation of TSMC is still pretty fair, pretty manageable. And I think as well, they're going to say what they've been saying a few times over the past few weeks, right? They're increasing their pricing across their product line for the next 4 years. They have super strong demand and their profit margins should be able to be maintained as well. And that is everything for your overall market rundown and big tech rundown. Now let's spend like 5-10 minutes talking about the biggest gainers and losers of the day. All right, so let's talk about some of the biggest losers, and we're once again going to talk about the software trade. Now, let me just get out and say it right out of the gate, right? For some people, not all, but for some people, these companies are in the uninvestable category. And the reason I say that is because despite the fact that some of these software companies are trading at arguably multi-year low valuations. I mean, every time CRM reports earnings, we cover them. We know that CRM around 240 is super cheap. Price to earnings basis, PEG ratio basis, phenomenal free cash flow yields. The same thing can be said about Adobe, right? Adobe, super low multiple right now. And the same can be even said about maybe even some companies like ServiceNow. ServiceNow trades at a very heightened valuation compared to some of its peers, but it also has some of the best products. But you know what the problem is? The problem is that in terms of a stock price, there's always three things. You might remember me drawing this pie chart a few times, right? There are fundamentals. These are the three things that affect a stock's price. Fundamentals, technicals, right, in terms of uptrends, downtrends, and driving momentum. And then there is the one that is the most powerful one of them all, which is sentiment. This is the hardest one to shake because some things can be fundamentally cheap, like a lot of these companies, right? Some of these companies as well can be oversold on a lot of the technicals, which we are seeing on quite a few of these names, right? Like, I mean, some of these names are just deeply oversold right now. Like, look at Figma, right? Deeply oversold on the weekly RSI. CRM arguably is also somewhat has been oscillating towards the lows of the RSI levels. Adobe, I mean, Adobe's daily oversold again, but they've just gotten crushed on the technicals as well. It's like you think that the selling just is going to stop eventually. But the most powerful theme is always sentiment, right? We saw that last year with UNH. It doesn't detract from the fact that these are solid businesses with solid fundamentals and that they've been trying to prove to the market with their most recent earnings releases, right? You know, Salesforce has had great earnings releases for the past few quarters. Adobe has had phenomenal earnings releases for the past few quarters as well. Dare I say, these companies have even been saying on their earnings calls that they have been using AI to better implement their services across different enterprises. But the market just doesn't believe them. You might remember last year, this was a problem for Google. For a long period of time last year in early 2025, people were saying that ChatGPT was just going to kill Google's overall business. But then Google proved everybody wrong by posting stellar back-to-back quarterly earnings. And eventually also the DOJ case was dropped. And then Google's price was able to rally, right? But you got so many names out there that are just getting crushed by the AI narrative. Duolingo is just another recent casualty, despite the fact that Duolingo is posting really strong revenue growth rates and things like that. It just cannot shake the sentiment. And so many names. We can look even further, right? AI has destroyed FactSet's stock price recently too. High quality company. They never usually had a problem with this. They got destroyed. ADP, automatic data processing. Arguably, this is a company that never really loses its longer term monthly moving averages either. That one got destroyed from AI over the course of the past 6 months. And so many more casualties. Companies like Intuit, very solid company with very solid recurring revenues. And they just got destroyed over the past 6 months as the AI narrative and the sentiment has taken over everything. It's taken over the fundamentals. It's taken over the technicals. It's all a question of sentiment, which brings me back to my introduction when I was saying a lot of these companies, for most people, are going to be uninvestable because most people want to see returns quickly, right? They're not willing to take a position in something like a UNH or an NVO or a whole host of other companies that have just gone absolutely destroyed for sentiment and take the necessary time to wait. Even Nike is like a sentiment, well, an execution problem mostly, but sentiment as well, right? A lot of these sentiment disaster trades, guys, they're not quick flips. So if you are choosing to buy into Salesforce for their business model, if you think that these companies will not be disrupted so much by AI, but they will be able to use AI to their advantage, and you're willing to buy these companies at arguably multi-year low valuations, then perfect, right? But you will have to stay in these companies until the sentiment turns around. And nobody's quite sure when that's going to be. What they'll have to do consistently is keep proving to the market quarter after quarter with their earnings that their revenues, their margins, their free cash flows are unaffected by the AI narrative. And that additionally, they are using AI across their business to better their offerings for clients. And only then, when you kind of start to stack the wins back to back, will you finally start to see a sentiment shift, right? Wall Street and retail's not just going to wake up tomorrow and say, oh my goodness, Adobe is so cheap. No, they've had 6 months to do that, more than 6 months to do that, and it's still not there, right? This is just an unfavorable trade, but it's not only limited to there. Even more companies, right? We talk about Team is also multi-year lows as well, but even some of the cybersecurity plays today, like nobody was safe, right? Even UiPath with just pure play AI, in my opinion, right? Even they were down 7% today. Even some of your AI-oriented insurance companies. I mean, a lot of insurance was down today. Root, Lemonade was down, but it seems as though when there's an AI development like Claude from today, right? It's just this whole aspect of the market comes down together and it's just disrespectful selling all across the board. Nobody is safe, right? So keep that in mind. I'm not saying that these companies are bad buys. I'm just saying that if you're buying them down here, you're probably going to have to wait. It's not going to be a question of daily recoveries nor weekly recoveries. No, you're talking about like quarters and quarters worth of a recovery, right? Now, it doesn't mean that these companies don't have nice compound annual growth rates ahead of them if they can turn things around. That is for sure. Nobody's doubting that. As I said, we cover these companies every single quarter, and we keep saying they're super cheap, just like UNH is super cheap. But it's the sentiment around the stock that takes so long to turn around when the damage has been done, right? It takes long to turn around. Now, some of these are what I like to call they're bluff calls, right? Where you can say, I think the market is wrong, I'm calling the bluff, and I will take a position. Now, when you do that, you stand to sometimes make a lot of money when the market is wrong and you have a very solid thesis, right? Now, some bluffs are easier to call than others. You might remember when AI dropped SPGI and Moody's a few quarters ago, I was saying these are some of the easiest buys in the market because it's not only AI. They're targeting the analytics portion of their business, but these companies are duopolies, right? They have the credit rating agencies that'll never be disrupted by AI, right? So I was saying that these are some of the easiest buys in the markets, Moody's and SPGI, after these quite substantial pullbacks around the same time that all different aspects of software were being quote unquote disrupted by AI. Other narratives, such as like the short-term Visa narrative from today and yesterday, Visa, MasterCard, these are very easy bluffs to call because it's a short-term news impact that's not going to disrupt the long-term network effects of the companies. So those are easier bluffs to call. Arguably, even last year, right, the bluff was easy to call on Google stock, right? It may not have felt good for a while, but it was an easier bluff to call because these companies are just so big. Some of these other plays, let's be honest, right? The bluff isn't so easy to call. I mean, we can derive some very nice fundamentals on Adobe, and we go through their earnings every single quarter, as I've said, right? But it's not the easiest bluff to call. You can say that they have very solid fundamentals, and management keeps saying that they're using AI, but it's like you're not sure. It's kind of like the whole Uber situation as well, right? You're pretty sure that autonomous vehicles won't completely erase Uber's business, that Uber and autonomous vehicles will be able to live together for quite some time, right? But some of these narratives are easier to call than other ones. And I wouldn't say that for a lot of the enterprise resource companies like CRM or, Adobe and, big software players like that, I wouldn't say that this is the easiest bluff to call, right? You might know a lot about these companies and they may look like some of the best buys in the market, and quite possibly they are. But you're always going to have that little bit of a doubt in the back of your mind, something that you probably don't have as much with like a Visa or a MasterCard when they sell off, or maybe like Google last year or things of that nature, right? No, these are a little bit more difficult to get behind, at least get behind with some size. If you're correct, you stand to make a whole bunch of money. But if AI does prove to be the great disruptor of these companies, well, unfortunately, your thesis will be invalidated and you may just have to exit the position. So these should only be taken with a very long time horizon in mind, going for the recovery of sentiment, which can take multiple quarters, as we said. That being said, right, even Figma, a company like Figma, right, they were the hottest product when they were a private stock. And then Adobe even tried to buy them a few years back for $20 billion. They're trading under what Adobe tried to buy them for just a few years ago, because once again, AI can possibly disrupt their product. Now, is it a decent pickup down here in terms of Figma? If you believe in the product and you believe in the longer form recovery cycle, yeah, but it's not going to happen overnight, right? You'll have to kind of accumulate, kind of like Palantir was back in 2022. A lot of these plays, you're just going to have to get stuck with them for a while and wait for the market to start appreciating your thesis once more. So you can make an argument for a lot of these plays, and I would agree. My favorite one that was down today is UiPath. UiPath down here, 16 to 15. We covered it a few times on the channel. 16 out of 14, solid play, pure play AI, and they're also still at multi-year lows, and they're in the mid-cap region, right? $2 billion to $10 billion range. I think they have very good growth ahead of them. I think they have a phenomenal product that's going to make the most out of AI, at least more so than maybe some of the legacy players out there in terms of cost structures and whatnot. So UiPath could be a very interesting play as well. Lemonade, a few people have asked me about Lemonade. Lemonade for me is It's a play, but you have to buy it with the premise of being willing to DCA, right? Lemonade was the best opportunity, let's be honest, down here, like in the $40 to $50 range. That was best pricing, because Lemonade is not a profitable company just yet. It's a $6 billion company. They're disrupting legacy insurance companies. I do believe that they'll continue to carve out a decent portion of market share. However, you got to keep in mind, guys, this company is just not yet profitable, right? And won't be profitable on EPS for a few years to come. That being said, revenue expansion is phenomenal, but you can't really say that they're excessively cheap, right? They're on the cheaper end of what you're looking for a fast-growing tech company that's disrupting a legacy industry. So Lemonade for me up here is a buy, but it's also a buy through 60. So I hope we don't buy up here expecting the same amount of juice that the people that bought at 20 or 40 got last year. That's probably not going to happen, but can Lemonade be an interesting play for the next few years? Absolutely. Moving on a little bit further to the downside here. What do we want to talk about here? SMCI getting a downgrade today. SMCI is a lottery bet at best. Their timelines of execution have just been terrible. Management has just been unable to expand margins, quite frankly. I mean, they do have a nice partnership with NVIDIA. They're providing server racks. They're providing liquid cooling. That's cost them a bunch of CapEx to do so, though. EPS should be curling up this year, and revenues also going to be booming over the next 2 years. But SMCI has its host of problems. It's in the lottery play category for me overall, right? I would much rather play companies like Marvell down here for some expansion. I would much rather play companies like AMD or companies like NVIDIA for some possible expansion. Those are probably my favorite 3 semiconductor plays, moving into the near-term future down there. Now, I think that's kind of, we covered, the credit cards were down today, the banks were down today, so we covered that. Software is down today, so we've covered that. So rather than me going through individual names, right? I mean, I guess Zeta is interesting, guys, and I will be building a position in Zeta. From here all the way through a back test to the 20s, I think the valuation is very manageable here. It's like a 3.3 price to sales. I think they have a nice growth rate ahead of them. Mercado Libre also is a no-brainer buy down here. We've covered this many times. 21 down about 19, no-brainer buy, still in the context of monthly consolidation, right? And still a phenomenal growing company, right? Under a one peg, huge, decent free cash flow. Look at the expansion from Mercado Libre, right? It's absolutely ridiculous, the expansion this company is having over the next few years. Look at this EPS ramp and look at the revenue ramp as well, right? One of the fastest growing companies on the planet currently for what they are. Huge revenue and EPS growth. No-brainer buy. I figured I should throw it out there since they did consolidate recently after their push. Maybe some last opportunities out there. Constellation Software is a company, Canadian company that I'm buying. This one also got sold off because of the AI narrative. Even though AI can't really disrupt the segments of business that they do, largely government contracts, healthcare contracts, for outdated some things that just AI cannot replace just yet, at least. So Constellation Software, I've been nibbling a little bit back there. One of the best sell-offs that we've gotten in recent memory for all the Canadian investors out there. So keep that in mind. Speaking about other companies I've been adding some SCHD since the beginning of the year, just to play on these value and dividend rotations, something that hasn't happened for a better part of, let's be honest, the past like 3-4 years. Value dividends have been crushed. I mean, so many companies like, Kimberly-Clark is down here, multi-year lows. Procter & Gamble is down here as well, multi-year lows. All these dividend companies, and even some of the oil stocks, right? Like Chevron hasn't done anything in the past 4 years. Exxon hasn't really done anything in the past 4 years, although they are breaking out right now. And even some of the midstream pipeline companies that have data center exposure, like Enbridge, phenomenal pick here, looking for the breakout retest and possibly run on Enbridge. I've been picking up a little bit of Enbridge, fantastic company, almost arguably a monopoly in some segments of Canada up here, but they also have a lot of U.S. operations as well. Phenomenal dividends. So I'm picking up, some companies, and I'm doing it with SCHD. I'm not buying those dividend companies individually, but there are some decent ones that pay decent dividends, like legacy companies like Pepsi pays like a 4% dividend. A company like UPS all the way down here, still at the lows, they still pay like a 6% dividend. Companies like Altria, which have just been doing a nice breakout retest here of the mid-50 zone, that pays like a 7.25% dividend. So there's many ways to pick up these dividend companies. Dividends are not for everybody, but I'm building out a smaller portion because I think we're into kind of like a cyclical, maybe bull run for some of these value-oriented companies, the more consumer-oriented companies. As you have the decline of rates, you might just get expansion of some segments of the markets that haven't done too much. So I'm just playing it with a few, like the only true dividend stock that I've bought recently is Enbridge. This is just as a play on nat gas for the data centers. So basically an energy thesis, but also because they do provide a decent dividend and because the chart looks great. I know there's many LNG plays out there, guys. I'm not going to go through each one. This is just the one that I've chosen. Whether it's the best or not, I don't know, but it provides a stable dividend. I mean, Energy Transfer is a decent other company, right? They pay a huge dividend as well, almost an 8% dividend, and they might be looking for some base out effects and possibly some expansion with the data centers, very closely tied into that whole niche narrative as well. So there's a few things, as I said, this market, there's a little bit of something for everybody. Those are just a few plays that I'm kind of going over on a day-by-day basis with you guys. So we'll try to cover a bit more of these as we move throughout the week and we kind of see these themes that either drop and pop on a daily basis. But, you know, some of the key themes remain energy, defense corporations, and cyclicals, right? Cyclicals meaning the value names, the dividend names, right? Even some of the consumer retail names with some nice pushes to the upside, and you know, some of the data center plays that have come down recently. I mean, shout out to ANET. ANET, we are commenting on it down here. Decent pickup location. It's a monthly 12 EMA back test. Watch for ANET this year. Credo selling off after earnings because people were confused that they changed the color of the cables for Amazon data centers and they came down in a very wide fashion. And now we've been basing out with some nice support areas, phenomenal growth, and look, a 12 EMA back test. So we position in the Discord upon this little pocket right down there. And now we're looking for the re-expansion of this trade. So there's like, you know, second order plays for data centers, right? Connectivity plays like ANET, like Credo, right? For different purposes. There's plays like VRT as well, just consolidation range right now, monthly, just building into a bit of a monthly tightening range right here. Overall, not quite the 12 EMA just yet, but decent, very solid growth into the future, right? There's so many plays, but even, you know, some of the energy players that we've been talking about, FLNC, EOSC, right? Those are still, well, I mean, they're up a lot from the first time we talked about them down here on EOSC and FLNC. And so is a company like Bloom Energy, which you were talking about back here, which was, once again, right, very close to a 12 EMA back test. Now that one's kind of gone to the races, but there's still many opportunities out there. And even the names like NBIS, I mean, I cover these once every 2 days, but the pattern's been clear, right? This was your accumulation range. Why? It was backtesting the 12 EMAs or very close to them. Still an accumulation position for me. Iris Energy, right? Now, although now we're kind of getting a little bit elevated down here, 40 to 30 bucks is your best bet. That's where we bought a lot in the Discord as well. And now they're expanding nicely. A company like CoreWeave as well, right? Down here was the expansion range, trying to crack the resistance. So we're in the execution layer. And dare I say, even a company like Oracle, I don't really enjoy playing Oracle, but we're now still in the execution layer. This was the funding layer last year, funding and hype. Now we're building all the data centers. And then end of the year, 26 into 2027 is when you get the actual revenue from the data centers. So keep all that in mind if you're looking for the data center connectivity plays. Many opportunities out there, and I'll try to bring you guys some of those on a daily basis. But that's everything for today's video, guys. I said 5-10 minutes, and I spent 15-20 as usual. I always go overboard, but at least if you guys are paying attention to the key themes, and if I can highlight some names, well, maybe you guys have a good path to maybe build some trades or build some longer term positions. That's it for me today. If you enjoyed today's video, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing as well if you're new. We do these videos every Monday to Friday after the close. And last but not least, if you have any questions, feel free to leave them down below in the comment section. Always love to hear what you guys have to say. I'll be answering any and all questions today into tomorrow. And last but not least, if you are interested in, or if you're tired of trading and investing in the markets all by yourself and you wanted to do so as part of a trading and investing community with over 300 people such as yourself, you may consider joining our trading Discord. The link to join our community is down below in the video description. In that community, of course, you get access to a few key things. Number one, you get access to all my trades in real time, whether they are the wheel trades, which we use to farm premium in the markets, or the directional trades such as leap calls or call debit spreads or swing trades with shares on small or large cap companies, things of that nature. You get access to all the trades that I do on a weekly basis across my portfolios, whether they're the long-term investments or the trades as well. You also get access to our private morning live streams every Monday to Friday. I stream at the open for 2.5 hours. I trade live with you guys, but I also take all of your questions on your stocks, your options, and your long-term portfolios. You can obviously chat with us all throughout the day and ask me questions in our chat rooms. I'm very fast to answer all throughout the week and the weekend. And additionally, you get access to about 15 hours of private video educational content, how I choose my leaps, my debit spreads, different wheel trading strategies, how I do fundamental analysis, technical analysis, how to build a trading portfolio, how to build a long-term account. So many different very nice educational videos that I'll never put on YouTube are in that section. And as an additional bonus, you do get access to all of my charts. So whenever you guys see support resistance ranges that I put here, or, you know, different earnings breakdowns or fundamental breakdowns like this, you guys can just copy paste all my charts, all my watch lists. It's just an added benefit for you. So if any of that sounds good to you, the link to join us down below is in the video description. Hopefully I get to see a few more of you guys in there soon. And if not, I guess I will see you guys right back here on the channel. That is it for me today, guys. Have a good day in the markets. Tomorrow, I'll see you tomorrow after the close. Peace.